Welcome to the Deep Dive, the place where we take all the complexity of the market and, well, boil it down to the signals that really matter.
Today, we're getting into the third quarter 2025 earnings call for Nucor, a real heavyweight in North American industrials.
And this deep dive is really for you, the listener, who wants to understand the why behind the market reaction, because it reacted very strongly.
It really did.
The puzzle here is that management gave a pretty cautious near-term outlook, but the stock, it rallied over 5% on the day. It completely shrugged it off.
That's the whole mission right there. We were looking at a quarter that, it proves execution matters. But it's really about execution combined with capital discipline and, maybe most importantly, their strategic position in huge growth markets.
Like data centers.
Exactly, like the data center build-out. The market clearly chose to focus on the long-term projects finally coming online and basically call the Q4 seasonality, just temporary noise.
Okay, so let's start with the hard numbers then. The Q3 results, they beat Wall Street expectations pretty much across the board.
The financials were excellent. Revenue landed at $8.52 billion, which beat the analyst consensus by, about $360 million?
That's a big beat.
It is, and it's strong growth, too.
Yeah.
We're talking 14 to 15% growth year over year, which for a business of this scale is really, really impressive.
And the profit side of the equation was maybe even more compelling. I think that's what really drove that initial pop in the stock.
No question. The GAAP EPS, that's the standard earnings per share metric. It came in at $2.63. They just crushed the consensus estimates, which were floating around $2.19.
So a beat of $0.44? I mean, that's not just squeaking by.
Not at all. And when you look under the hood at how they did it, it really boils down to two things. First, volume. They pushed out 6.4 million tons of steel, which is an impressive 12% jump from last year.
And second, pricing power.
Exactly. They managed to get a 5% increase in their average external sales price per ton. So more volume at higher prices. That's the recipe.
And when you put all that together, the volume, the pricing, the efficiency, what did the cash generation actually look like?
They generated about $1.27 billion in EBITDA. And that's really our best measure for, core operational cash flow. A really strong number that led to a clean beat.
Okay, so beyond those raw numbers, what really stands out is this kind of strategic financial strength that underpins the whole company. It's something that I feel gets overlooked in the steel sector.
All about consistency and, frankly, the quality of their balance sheet. Management made a point to highlight their safety record, 8th straight year of lowering injury rates, which just signals good management.
Sure.
But financially, the really crucial news was a credit profile upgrade. Nucor is now the only major North American steel producer rated A or A3 by all three major agencies. Moody's just upgraded them.
So what does an A rating really signal to the market, especially right now? Why does that matter so much?
It signals stability, durability. I mean, it fundamentally changes the conversation around their cost of capital for future projects, and that strength lets them be aggressive, but in a very disciplined way.
Right, and they have the cash to do it.
They do. They ended the quarter with about $2.75 billion in cash and short-term investments. Huge liquidity.
And they remain committed to shareholders. They have that framework, right, to return at least 40% of net income.
And they're way ahead of that target. Through Q3, they had already returned nearly $1 billion, which is actually 72% of their net earnings so far this year.
Wow.
And they marked their 210th consecutive dividend payment. I mean, that's just incredible in this industry. Plus, they bought back about 0.7 million shares. It tells a story of a company that is just incredibly confident in its future.
So the credit rating proves they're sound. How does that strength translate to what we're seeing on the ground in their actual divisions? Let's get into the segments.
So performance was a bit of a mixed bag, but the trend in the most important areas was really clear. So in the mill segment, sheet and plate profitability was a little lower.
Okay.
But the bar and structural groups, what we call long products, they improved dramatically.
And long products, that's the steel for infrastructure, for major construction projects, right?
Exactly. And the strength there is just undeniable. The bar group, which makes rebar, actually hit a new quarterly record for shipments, the second time they've done that this year.
Which tells you that non-residential construction demand is just humming along.
It is. And that flows directly into their higher margin steel products segment. That's their custom engineered business.
The real value add stuff.
That's where the high margin is, yeah. External shipments there were up 4% sequentially. But the real story is the backlog. Their backlog for things like joist and deck now extends well into the second quarter of 2026.
That's incredible visibility.
It's huge. It shows you their customers are extremely confident.
Okay, so this is where it gets really interesting, and I think this is where we find the answer to why the stock rallied. It's the strategic pivot, the shift from spending money to making money.
This is the fundamental change in the Nucor story. We are not talking about construction plans anymore. We're talking about new capacity coming online right now.
So the big CapEx cycle is finally ending.
It's transitioning. The new melt shop in Kingman, Arizona, and the rebar micromill in Lexington, North Carolina, are both actively ramping up production as we speak.
And what's the timeline for them to actually start contributing to the bottom line?
Management was very clear on this. Both of those new facilities are on track to be EBITDA positive by the first quarter of 2026. So we are just a few months away from these huge investments flipping from a cost drag to an earnings contributor.
And what about the big one, the West Virginia project?
The new sheet mill in West Virginia, their biggest investment ever, is about 2/3 complete. Still on track to start ramping up by the end of 2026.
These capacity additions are huge, but the real mega trend here, the thing driving all the excitement, is data centers.
This is the specific non-cyclical structural tailwind that separates Nucor from the pack. Management spent a lot of time on this. They're citing forecasts of 60 million square feet of data center construction in 2025.
That's a 30% increase over 2024. I mean, that is just an insane ramp.
It's exponential.
So everyone's chasing this AI infrastructure story. Is Nucor just getting a generic bump from that? Or is there something specific they're doing that's different? How did they become this solutions provider?
That's the key question. And what makes them unique is their integrated approach. They can now supply over 95% of all the steel that goes into a data center.
95%. So from the foundation up.
Think about it. They supply the structural steel for the building's shell, the insulated metal panels, the sheet products. But crucially, they also supply the interior guts.
And that's where the Nucor Data Systems business comes in.
Precisely. They're ramping up domestic production of server cabinets, hot-out containment systems. This lets them go to a data center builder and say, we can give you a seamless supply chain for almost everything you need.
So they're capturing the entire steel spend of that whole 60 million square foot build-out.
They're positioned to capture a massive share of it, yes. And this is all paired with really strict capital discipline.
Right. They made that big decision to scrap the planned rebar micromill out in the Pacific Northwest.
And that's a perfect example. They looked at their map, they looked at the new Kingman facility coming online, and they realized they could serve that whole Western market more efficiently without building a brand new mill.
So instead of spending that money on a commodity product, they're repurposing it.
Exactly. They're taking that capital and redirecting it to support the high-growth, high-margin Nucor Data Systems business. It's a powerful trade, moving CapEx from a low-growth commodity to a high-growth infrastructure solution.
And finally, you can't ignore the trade policy tailwinds. Management was very, very clear that these need to stay in place.
Favorable trade enforcement is definitely helping. Finished steel imports are down almost 11% this year, and sheet imports are down a whopping 35%.
Which supports domestic pricing.
It does. And management's view is simple. The Section 232 tariffs have to stay. They're necessary to counteract global overcapacity and protect these massive domestic investments.
Okay, let's talk about the guidance, because this is the confusing part. The headline for Q4 was consolidated earnings expected to be lower sequentially. That sounds bad. Why did the market just ignore it?
The lower guide is mostly mechanical, and it was largely expected. You have typical seasonality, you have 5 fewer shipping days in the quarter, some planned maintenance outages.
So a bunch of little things.
Right. But the biggest factor was the expected dip in realized pricing, mainly in the sheet steel business.
So what does lower realized sheet pricing actually mean for Q4 in plain English?
Think of it like this. They are finally shipping steel based on contracts that were signed months ago, maybe back in Q2 when prices were a bit softer. So that old lower price is only now hitting the balance sheet.
Ah, okay. So they're clearing out the old lower priced inventory in Q4, which means the new higher prices that we've seen recently should start hitting the books soon.
You've got it. That's the critical pivot point. Management believes those recent price hikes will flow through and be fully realized in Q1 2026. And because inventories, both at service centers and Nucor's own mills, are pretty low, that price realization should happen fast.
So the market basically looked right through the Q4 lag and priced in a strong start to 2026.
That's exactly what happened. And looking even further out, the biggest news is the long-term shift in capital spending. Once these big projects are done, total CapEx is expected to drop by more than $500 million in 2026.
Which means a huge increase in free cash flow.
A torrent of free cash flow. And that cash is being redeployed under their expand beyond strategy. So the focus shifts to what they call steel-adjacent businesses.
These are the counter-cyclical, high-margin businesses.
Right, low capital intensity, high margin. They're trying to divorce their stock from the classic boom and bust steel cycle.
So things like towers, energy infrastructure, and of course more data center components.
Absolutely. The goal is to stabilize earnings, to create a much more resilient platform with higher lows throughout any economic cycle. They see stable steel demand in 2026, but they're building a business that can thrive even if parts of the economy, like housing or heavy equipment, get a bit soft.
All right, we are now entering the segment where we explore an outrageous but plausible trade idea. And just to be crystal clear, this is analysis, not financial advice. Think of this purely as a thought experiment.
So the consensus view on Nucor is that it's just a simple cyclical play. It goes up and down with GDP and steel prices. We propose something a little different, a thematic directional trade.
Okay, let's hear it.
Long Nucor, financed by a short position in the broader metals and mining ETF, which is XME.
Whoa, okay. Shorting the entire sector to buy one company within it, that's definitely aggressive. Why that specific pairing? What's the core idea?
The market data from earnings day basically gave us the signal. The Nucor rallied 5.43%. The entire XME index, the whole sector, barely moved, up just 0.6%.
So clear decoupling.
The decoupling in real time. We are betting on Nucor, the infrastructure solutions provider, not Nucor, the generic steel mill.
So the argument is that the Nucor story isn't just about the spot price of hot-rolled coil steel anymore, which is what usually drags the whole sector up or down.
Exactly. Our deep dive confirms why. Nucor has these specific, non-cyclical tailwinds. The record rebar shipments, the huge backlog in joist and deck. Those are tied to infrastructure spending, which is far more stable than general manufacturing.
And the strategic capital shift, the expand beyond idea that reinforces this whole trade.
It's the core of it, yes. Their explicit commitment to move capital away from traditional steelmaking and into these countercyclical businesses is designed to make the stock fundamentally less correlated with the XME over the long term.
So you're hedging away the generic market risk and isolating Nucor's specific growth premium.
That's the idea. You isolate the A-rated balance sheet and the data center dominance.
So to sum it all up, we've reviewed a quarter with a huge financial beat, a cautious guide that the market completely ignored, and a real sense of confidence in the company's long-term strategy.
Yeah, the narrative is really clear. They're moving out of a heavy, multi-year spending phase into a phase focused on maximizing the returns from those new assets and growing strategically in these high-demand, high-margin markets.
They're shifting from being a commodity producer to an infrastructure solutions partner.
That's a perfect way to put it.
So the key question this all raises for you as you watch this company is this. If the management is actively shifting capital away from traditional steel making and into these low-capital, high-margin solutions like data systems and towers, how much higher can the market ultimately value the stability that their expand beyond strategy offers? Something to really think about as you track those crucial Q1 2026 numbers.